Hi, I'm Brett Hickey, founder and CEO of Starmount Capital. Excited to be here with you today with John Tassone from FFT Wealth Management to give you perspectives from the top as part of Star Mountain's Insights. John, thank you for joining us today.
Great to be here. Thank you.
First of all, let's give the audience a little perspective. You, of course, have decades of experience in the investment industry and a large team and platform with global partners. Tell us a little bit about FFT Wealth Management.
Sure. For those of you that are familiar with the registered investment advisory space, we're a very large multi-billion-dollar multifamily office. I think one of the things that's a little bit different about our firm versus some of our peers is we've been investing in private markets and hedge funds, or alternatives broadly defined, for north of 30 plus years. So from a allocation perspective, we're doing a lot of things that we think are a little bit different, and I think at the end of the day really add value for our clients.
That's great. I think one of the things that you guys special in is really looking for high quality, long-term focused investment strategies where you have scale to do things, the right research, find the right opportunities, but you're also nimble enough and able to work with clients where you don't need to be doing things just because everybody else is doing it. You can actually look for strategies that may have some capacity constraints and may have some value from that perspective. Talk to us a little bit about, John, your views on the market today, and where do you think about private credit as one of the strategies that you've been leaning into for your clients? How do you think about that? What are you trying to achieve with that? And then we'll kind of work through some other items relating to how do you still get return while be defensive so you don't have to be sitting cash under your mattress?
No, that's a good question. I think it's timely because, as I mentioned, we've been investing in alternatives and private investments for a long, long time. We've had exposure to private credit for years. We have more exposure to private credit today because we think the opportunity set is just much more compelling than it has been, at least for the last 10 years. And there's a couple of reasons why. As we all know, interest rates have risen. And as a result, we're looking at strategies really across the private credit spectrum that can generate, in my opinion, equity-like returns. And for a lack of a better definition, or for purposes of discussion, I'll just say 10% plus net is kind of an equity-like return. And if you can get that through a private credit strategy where 60, 70, 80% of that return is coming through cash flow, I think the relative value really, really makes a lot of sense. And I think that's why you're seeing more and more folks getting interested in private credit today. Certainly the asset management industry has rolled out a number of different products targeted at different parts of the market, targeted at different types of investors. And so lots of opportunities, but with that, I would say, in terms of a caveat, is there are a lot of products out there and a lot of folks out there that rolled it out as sort of the strategy du jour, if you will. And so as an allocator, you have to be very, very careful and make sure you continue to do the work and focus on finding investment manager partners that really have done this their whole career. This is their reason for being. This is their business. It's not just another add-on because they see an opportunity to raise money.
I think that's a great point. So for some firms, particularly if you happen to be publicly traded, doesn't mean you will. But if you're really focused on needing to scale assets and what else can I do to gather assets, let me hire a couple people and now have this strategy. Those things, as we reflect on an 08, 09 environment, tend to start well, but perhaps not finish well. So you're really focused on people that this is their core strategy. They have real differentiated capabilities in what they do. And it means you might love a manager and one of their strategies, but if they're trying to tag on something that maybe isn't a core strategy, you're looking and seeing, well, what is a core strategy and a core focus of a manager? And you don't want to be in, and I'll call it an afterthought strategy.
Absolutely. And I think as that relates specifically to private credit, if you're familiar with the strategy, broadly speaking, it's hard. It takes a lot of work. Private credit, particularly in the lower middle market, is a very fragmented, inefficient space. And so having investment managers that can source the deals, that can vet the deals, and manage the deals when things are going well, when things aren't going well, that's critical. So I think your point about some asset managers out there have phenomenal brands and phenomenal businesses, and they do a great job. And we have seen that. We have seen some of those folks go out and they hire some really talented people and they say, hey, we're going to build out a private credit solution. Here's why there's all sorts of synergies with what we're currently doing, and this is why we think it makes sense. And the story, it's a good story. And if you know anything about Wall Street, they're master marketers. But once again, from an allocator's perspective, I think that's why it's important, and to really understand what their sweet spot is, what they grew up doing, really what they're focused on, and try to sort through some of the noise out there, because there is a lot.
And often in investing, people refer to it as being an apprenticeship business. And at the end of the day, what does that mean? Well, we learn things through time, through experience, and so forth. So having people that have lived through and invested through, 2001, 2008 cycles, and know what it's actually like to go through a challenge where on paper, of course, it's easy. Oh, you can just lay some people off, bring some other capital, sell the business. Well, not so easy if the whole market is challenged and revenues are down and sales are down and liquidity is dried up, and all of a sudden your workout team is very stretched and stressed. The world changes very quickly, as you know, and it'll be interesting to see. I'm glad I don't need to bet on the public markets for a living, because I've been wrong for a while thinking that we're due a downturn as we look at a lot of the air pockets in the economy. But ultimately, when challenges come, they tend to be harder than a lot of people anticipate. And so if you haven't built for that in advance, we almost think of it like a SWAT team, whether it's the fire station that's ready. They don't say, oh, there's a fire, let me now figure out what I do about it. They're ready for a fire. They've trained, they've prepared, the resources are ready, they're ready to attack that fire before it gets out of control. And we tend to find that challenges are similar, even as we think as an allocator with our secondaries private credit business that we've been doing for almost 15 years, that we think about how is somebody built to work through challenges, not saying, well, I've got 2 people on a workout team. You've got to be ready. You've got to be ready to tackle things and tackle them quickly and make often very consequential decisions that can be tough decisions to make. What are some other things, John, you think about? The audience out there has seen private credit grow a lot. It's grown to almost a $2 trillion space. Some predict it's going to double again over the next 10 years or so. Of course, the relative value today, as you say, with rates high, with a questionable economic environment, there's a lot of value proposition. How do you avoid the challenges and find the good opportunities? What are some of the key things, let's start with, that you try to avoid specifically as you're looking at a manager, a strategy? You talked about it not being a bit of an afterthought where they're just trying to raise assets despite being a great brand. Is one good one. What are some other tips that you'd give people that you focus on in your fundamental diligence?
Yeah, I think a couple of things, and it's not going to be in any particular order, but as Brett mentioned, one is this their core business? Is this what they were built to do? Is this what they think about, when they go home at night? We think that's really important. The other thing is, and this relates to the comments we mentioned earlier about some asset managers, is we don't like style drift. So if in the private credit space, if a private credit manager is focused on the lower middle market, and all of a sudden we see them competing in the broadly syndicated loan market doing huge deals, that would give us significant pause. We don't like that. We think that's something that you really need to be aware of, because once again, they'll tell you a good story as to why it makes sense. The deals are all the same. They're just bigger. It's just more zeros and that kind of stuff. But we don't go for that.
The supply demand, the players, the way it's a very different world as you grow up in different market segments.
That's right.
Isn't it?
So style drift, very, very important to be aware of. I think qualitatively, when you think about managers, you really need to focus on the culture. And for me, and I've interviewed thousands of investment managers over my career, and I think the consistent theme when I think about the most successful and admirable organizations is that culture and really the tone at the top. I think it's critical to have the senior folks of the organization setting that tone, and oftentimes I find the senior people are frankly the hardest working people in the firm, and it's basically a lead by example approach. And I think that's really important because having been on Wall Street for a long, long time, there's this narrative around the culture. It's a dog eat dog world. They throw you in the water and see if you can swim and all this kind of stuff. And yeah, there's a lot of that. And I don't think that is a successful way to run a business. In my experience, just observing it's not. What I've seen really work well is the senior people working really hard, inspiring the junior people to try to earn their admiration and their respect. And that to me is much more powerful. It's a much more powerful motivator than trying to rule with an iron fist and rule through fear. Because you might get some results in the short run, but in the long run, it doesn't make sense. And once again, going back and thinking about the organizations that I most admire, that I've seen over my career, it's really those that set that right culture, senior leaders working hard, leading by example. At the end of the day, everything else follows from that. Good performance, thoughtful investing, great client service, and everything else, because you've got a motivated group of people working together, not because they're afraid of getting fired, but rather because they want to do better for their clients.
It's a great point in a couple of things to double click on what you just said, John. One is, it's sitting on the global board of Harvard's alumni entrepreneurs and having partners that are former partners at McKinsey and Goldman and other places. We're really big on content and studying. And at the end of the day, a lot of life is psychology, who you're working with, how you're motivating people, and motivation through engagement, purpose, excitement. There's no question in all empirical data that is what is better. So to your point, making sure you've got the right incentive, right alignment, like at Star Mountain, for example, our value system, our STAR values, S is operating like a shareholder. Well, it's great to say, so we give profit sharing and carried interest to 100% of our U.S. employees, so that everybody actually, in fact, is. Most of our team are personal investors. Certainly all of our senior investment team has to be. But you think about leadership as well. It's interesting what you say, and we all actually know the right answer, but I think in diligence, people forget to do it. I've never seen a leadership book that says you should sit back from an ivory tower, and opine on what everybody else is doing. You should be in the trenches, whether it's in sports, whether it's in military, whether it's in business, and any type of leadership. You're in with your sleeves rolled up, you're leading by example, you're working with your team, you're getting in the trenches. And it's going to be interesting to observe, because as we think about an aging demographic, which of course with our lending strategy, we're mostly making strategic add-on acquisitions of motivated sellers. So it's a great opportunity. But with our secondaries credit business, when we're buying an LP interest in a private credit fund, often at a discount, we're evaluating those managers. And to your point of living and breathing in this space for decades, we know them personally. Are they still focused and still motivated? Look, I know plenty of people in their mid-60s that are extremely driven, extremely focused, and are really all in and have drive, ambition, motivation. They may even have more capacity now because their kids are out of the house. So that can be great. But then you see other people that are not. They're focused on a whole bunch of other hobbies and stuff, and that's fine in life. But in business, you want to back people that have both experience and that focus and drive. It'll be interesting to observe, because we're in a new generation now. And some leadership will remain driven and focused, and some will drift into other passions, and hopefully then they'll pass on appropriate leadership. But we've seen certainly with some of the publicly traded asset managers, some of them have been doing a good job of that, others have been struggling. I think that's the same thing that we're now, as allocators and investors, all going to have to get better at evaluating and really getting to know the people and making sure we're understanding their motivation, their focus, their alignment, because these are long-term investments often.
Right.
And challenges is when you really need people to hunker down and focus, not say it doesn't really matter, isn't it?
I mean, the classic in this business is, everything's great when the market's going up. You really learn who you're partnered with and what makes someone tick when you go through a financial crisis type event or a COVID event. That's when you see the true colors come out. And it's difficult to make subjective assessments, but that's why, from our perspective, when we're going through diligence, it's really very much a mosaic approach, right? So there's not one single data point that either makes the deal or breaks the deal. We cobble together a number of different data points that we gather in a bunch of different ways, and we try to create this mosaic, which paints a picture for us that says, you know what, we think that this particular manager would be a great partner and a partner in the truest sense of the word. And for us, that's really important. And we try to be that for our investment manager partners as well.
Sure.
Because once again, everything's great and everyone's wonderful when the market's going straight up, but we know that there's periods of time when it's not.
I think that's a great point. I think it's a good thing to, end on, John, is two things. One, risk is a multivariable equation. It shouldn't be an emotional knee-jerk reaction. You need to have a formula. You need to understand what matters and have a plan and approach, as you guys do at FFT, to tackle it and make sure it's with experience, with knowledge, with relationships, with that market insight to really figure that out. And you talk about partnership as well. I think it's one of the things that Wall Street sometimes gets wrong, where it can sometimes be very transactional in the big company world. When we're working with privately owned businesses, for example, just like when you as allocators are working with us, you want information, right? You want insights. You get that much more when you actually create a real relationship and partnership with senior people. So you're engaging, you're understanding. We've passed on investments where we got to know people and, through the relationship, oh, it's exciting. I just got this place in Florida. I'm doing this and that now. Great. As a friend, excited to talk to you about all that. But as an investor, I want to hear, I am hyper-focused. Here's the new investments we're making with technology. Here's how we're taking advantage of AI. Here's how we're building up our new office in Tampa. Whatever it might be, we want to see how you're driving into the future and you're passionate about that, not all these other things. Which again, as a friend, great. I'm glad you have all these other passions and you love deep sea fishing and you're excited about your new boat, or you brought your golf game better than mine is, which is unfortunately a pretty low bar. But I think that aspect of focus and alignment is going to be something that's critical, especially in a downturn. So if there are challenges, you want to get real insights from people. Say, hey, how can we help? We're in this together. I think that's a great piece of sage advice, because you'll get better due diligence, you'll get better monitoring, better reporting, and then maybe you have an ability to help even,
right?
Versus grinding somebody, that kind of like managing people, you said, right? Like grinding people out of fear doesn't drive the best behaviors. I think that's a really good reminder for investors, and I think one of the reasons you guys have been so successful with FFT is having real partnerships and people that want to work with you and want you as a partner. So well done and congratulations on everything you built, John.
I appreciate it.
Thank you.
Thanks, Brett.